Well, I think we're going to move to a 1% handle, real GDP growth, both in the fourth quarter for last year and certainly for this year. Yes, the economy is slowing, but one of the things that no one is talking about is that the Federal Reserve is pivoting and, in fact, is starting to react to the slower economic growth, not only in the U.S., but also abroad. And that should cushion the slowdown in growth. Yes, the Philly Fed was a little bit weaker, but if you dig down into the details, the employment component almost jumped by 50% from the prior month. Employers would not be hiring more people if they were really terrified about the future. And guess what? Yes, the housing numbers were a lot weaker, but that is exactly what happens when the Federal Reserve raises interest rates 9 times. The interest-sensitive sectors of the economy, like housing and autos, tend to get a little bit weaker. But a 1% handle is still considerably far away from a negative number that would indicate risk of recession, in my judgment.
Anthony, I'm not sure where you've been if you don't think anyone's talking about the Fed pivot. But anyway, Lakshman, to his point, the fact that the Fed has pivoted and I guess has a lot more room to ease if necessary than other developed world central banks, does that mean that a recession is highly unlikely, even if it does need some kind of stimulus to prevent it?
No, it doesn't. We have a cycle slowdown. It's been going on for a while, as Anthony was intimating. I guess back in Q3, we were at a in Q2 we were at a 4 handle. Q3 we were at a 3 handle. Q4 is probably a 1 handle. I think the Atlanta Fed just came out adjusting it down, their guesstimate to 1.4. So the direction didn't just start slowing, it's been slowing. And, you know, let's not forget retail sales fell quite a bit. Growth, IP is falling. The jobs numbers, when we look at the big picture, not any one statistic, but a group of statistics are softening. So, you know, I think in December, that 300K that we initially had printed was revised down by 90,000. We'll see how that holds up going forward. All in all, when we look at the big macro cycle numbers on growth, you have a slowdown. It's not the end of the world, but when you're slowing, by definition, you start to come a little closer towards recession risk. The really key thing is if the forward-looking leading indicators are bottoming and turning up, and they haven't done that yet. So that's the real kind of elephant in the room. The other thing is inflation. You know, let's not forget that it peaked in July. So it took a half a year for the Fed to kind of acknowledge that, which they've done. And look, better late than never. But I wouldn't call them terribly fast here. From where we're sitting, this is kind of obvious that they were going to have to change and pivot. The question is, of course, we can't predict the predictors, but where do those leading indicators go? Do they bottom in time or not?